Welcome to the latest Savings Guru podcast. I'm delighted to be joined today by Ewan Edwards, who's the Savings Director of Aldermore. Ewan, welcome to the show.
Thanks, James. Good to be here.
Thanks for joining us. I'm really looking forward to talking to you today because I kind of see Aldermore as the original challenger bank. You were kind of the first one to go in May 2009. Perhaps you can start, Ewan, by just telling us a little bit more about the history of Aldermore and how the bank started.
Sure. So Aldermore was born out of the financial crisis in 2009. They do say that every kind of crisis brings an opportunity, and our founding fathers recognised that there was an opportunity in the UK sort of financial services marketplace that were not being as well served by the big established banks. Aldermore is a specialist bank offering straightforward lending and savings products to a couple of markets: small and medium-sized enterprises, so SMEs, homeowners, landlords, and individual savers. So quite a simple product and market set. We have no branch network, and we serve our customers and intermediaries mostly online and also with some telephone support. And since that time, we've grown to around 500,000 customers across all the business lines, and all our operations are based in the UK. The bank made its first profit after 3 years, and then in 2015, the private equity backers floated the business, and Aldermore entered the FTSE 250. And then in 2018, Aldermore was acquired by FirstRand Group of South Africa. FirstRand are one of the so-called big four banks over there, a bit like we have in the UK.
Yeah.
FirstRand already had a UK business, actually, Motonovo, which is a car financing business based in Cardiff. And essentially, they wanted to, initially at least, shift their funding model into sterling as a way to avoid exchange rate risk. But they also saw in Aldermore a disruptive player that had grown really quickly and organically, which they felt they could take to the next level with all their kind of help and support. And to be honest, that integration's been pretty seamless, actually. We retain the Aldermore brand, as I'm sure you can see. We keep the FCA license, the FSCS protection, and essentially the same management team. In fact, in many ways, customers would be none the wiser. The result really is that we've retained our challenger brand credentials and our challenger ethos, but just now with the kind of added support and resources of a large parent. And we think that's good for customers and colleagues.
I think that's a really good point there. I think it's quite unusual when you see a big brand take over another company that, as a customer, it's rare that you don't see sort of any sign of that. Usually there's sort of some change in the way things operate, but I would say certainly from the outside, I've seen little evidence of kind of a big parent takeover at Aldermore. I think your point there about I don't think savers would know particularly. It is quite a positive thing that you haven't had a big company bearing huge influence on what it seems from the outside they've largely left you carry on to do what you have been doing.
That's right. They have, absolutely. I mean, obviously behind the scenes, there's things that go on in terms of
course,
some of the MI integration and the legals, but absolutely to the outside world, it's still Aldermore. We still operate in the same markets. So yeah, absolutely. It's very much a kind of behind the scenes merger, if you like. I think that's testament to the brand equity and the success of the Aldermore brand in the UK. I mean, why would you give up on a success story? So, and I think, no, they definitely saw an opportunity to retain the brand, to retain the management team, and in many ways retain the strategy, but just with that added protection and resources. And that's, as I say, that is ultimately good for customers, and obviously it's good for colleagues as well.
Yeah, you mentioned there the 500,000 customers milestone. Your last published results, you'd gone through 10 billion of savings, which is a pretty significant milestone. What's the kind of plan next? How big do you think that Aldermore can grow?
You're right, James. I mean, we passed that milestone this year. In fact, we actually did close on 11 billion by the time the results were announced. Particularly strong growth in personal savings. We've also got a business savings book as well. So when we talk about savings in Aldermore, it's worth just reminding ourselves that we have a personal savings franchise and a small business franchise. In terms of growth, I think there's a lot more we can do, both in terms of what we've been doing historically, but also in terms of what we might do differently now that we're part of the bigger group. I think if I look at the UK business, Aldermore has a number of finance divisions, business finance, car finance, all with their own customers. And I think one opportunity is to be able to distribute savings accounts across those customers and to deepen those relationships across the group. But I think also we can develop the savings franchise more in the UK and to actually think of it as a franchise rather than just seeing it as a funding vehicle for assets. We internally, at least, we describe our mission within savings, our objective, as great returns effortlessly. And I think that sort of sums up our offer to the market and what's important for customers. It was relevant over the last 11 years. And I think it's still relevant going forward. And it plays to, I think, what's really relevant to modern savers. They look for a great return. That's obvious. It's a very commoditized market. A new player can do nothing else really in terms of its rate position. But effortlessly, I think, also talks to two main elements, I guess. One is the need for really simple, always-on, frictionless online processes, which obviously is right for the times. And to back that up with people support behind the website, real people, sat in the UK answering calls when you need to. Most customers are happy to open their accounts and serve them themselves online, but with the reassurance of knowing that there's people sat behind the website. And that kind of combination, if you like, of digital and human, we think is a really powerful combination. And as I say, it's served us well in the last 11 years. I think it will continue to serve us well going forward. And I think critically as well, James, it's a real differentiation from the big established banks. And yes, rates might be low in absolute terms, but we're still able to offer a relatively good proposition, both in terms of rate and convenience.
I was going to ask you about what's been your reasons for your success, but you've probably covered a lot of that. I think from my perspective, as someone who's obviously got a keen interest in this space, I've noticed things like I think you were one of the first really to embrace customer feedback, particularly, and certainly I've noticed that things that where you did get constructive feedback from customers, it was seized upon pretty quickly, and things were tweaked and tailored and improved. But it seems to be that's where your focus has been, really kind of trying to make a difference there.
Yes, you're right to pick up on that, actually. I think that aspect of our journey where we invite customers to give us ratings, and we publish those ratings on the website, as I'm sure you've seen, and they're unedited. In fact, I think we're one of the first FS providers to actually do that. And I think that's important for a number of reasons. First of all, it's a very explicit demonstration that you're a customer-centric business. If you're prepared to publish unedited reviews on your website of what people think about your service and products, then I think that says something about your ethos and your transparency. And you're right, we've been doing that for many years. We have an established voice of customer program. We regularly invite feedback after a number of triggers, whether that's new account opening or maturity. And we're really proud of it. We have net promoter scores are in the range of between 50 and 60, which is great. And also we invite customers to use external platforms as well, James. So you're probably familiar with Trustpilot, which is one of the more established of the sort of third-party review sites. And again, if you take a look at that, again, we're very proud of our performance on that. So we're currently rated as excellent, where we've got more than 4 out of 5 stars. Again, very similar to our internal voice of customer survey. And I think that's important in a kind of modern digital space where, let's face it, savings is a relatively commoditized market. And we think this is a way of extending our reach, reinforcing that great returns effortlessly mantra. And we're really proud of it. And I think also internally, by having that, it just keeps us on our toes. It drives that kind of continuous improvement. I personally read Trustpilot every day. It's a bit like my own intranet. I'm always reading it, and take great pleasure from seeing the comments. And we exist to serve customers, and when they give you that feedback and you can read it in real time, it's fantastic.
Yeah, I can certainly relate to that myself. Inevitably, you have to deal with the occasional time when things go wrong, but it's a pleasure when you then get the correspondence from customers saying, thanks, you got it bang on there. I think what's really interesting is that the sheer volume of customer reviews you get, which I think for me always tells a story. I think if customers see that there isn't an acknowledgement and a reaction to their feedback, then they kind of stop doing it. If they don't see that take on board their feedback, then they kind of stop bothering. And the sheer numbers that you have on your ratings says that clearly your savers do feel that it is taken on board. They feel like they're validating what you've just said there, and
absolutely,
by continuing to give you that feedback because they believe that is being acted upon. And you mentioned that you've got the business savings, which is a very significant proportion of your book, and you outsource though the operational management of the personal savings, but you manage business savings in house. I wonder if you could kind of talk a bit about the reason for that sort of split servicing model.
Sure. So when we first launched Aldermore back in 2009, in order to kind of get to market quickly and make the most of the opportunity, we turned to an established third-party administrator for savings servicing. As I say, this provided a kind of turnkey solution, and critically is invisible to the customer. So customers hear, read, and see Aldermore in terms of the website and in terms of the telephone service. In fact, we even treat the third party as very much part of the Aldermore family. So in personal savings, it definitely got us to market quickly, with no customer detriment. And of course, the other thing they do is they bring us operational bandwidth. So when you're having periods of high demand, they have the operational capacity to be able to cope with that in a way that would be more challenging if we had it in-house. In the case of business savings, that came along a few years later in 2012, and the same third party at the time didn't have a corresponding business savings module. So instead, we worked with a separate supplier, a fintech, who were able to develop a more bespoke solution to suit our needs. And also, we used our own internal Aldermore colleagues for the customer services team. Both teams are based in the UK. I think that's quite important in the UK savings market. And I think that model, that split model, if you like, provides a degree of operational resilience, but also allows us to diversify our funding, as you said. And it's worked really well. But to the outside world, and also within Aldermore, it is very much look, see, and hear Aldermore. The fact that we use a third party is purely for operational convenience and flexibility. They very much live and breathe the Aldermore values, if you like.
That's a really interesting point, and as you'll be aware, I know that third party provider myself quite well, and one of the things that struck me is the difference between the providers that use them in terms of some treat it very transactionally, and others like yourself clearly integrate them as part of the team and have them as an extension of the brand rather than treat them as a separate entity. And I think that makes a huge amount of difference in terms of the results you get back as a consequence.
Absolutely. I mean, as I said earlier, we very much regard them as part of the team. I mean, I don't differentiate particularly between whether they sit in the third party or sit within Aldermore itself. As far as I'm concerned, we're all supporting the Aldermore savings proposition, and we operate as one team. The other thing I'd add actually about particularly about our personal savings operation, and an example really of how we really obsess about customers. We talked earlier about customer feedback loops and ratings and reviews, but we also really take the trouble to make sure that the offline processes, if you like, when people have a reason to speak with us, are as good as they can be. most customers in savings are happy to self-serve. Most people will open their account online and service online. But there are occasions when online processes, don't really lend themselves particularly well. So if I think about, various aspects of kind of customer vulnerability, or whether it's those kind of emotionally intense processes like, for example, bereavement, or things like power of attorney, where they're quite high risk, quite emotional processes, quite complex processes in many ways. Actually, they don't lend themselves particularly well to online processing, and that's where I think the power of an established human team can really support your proposition, because those kind of moments of truth, so-called, can often really colour your relationship. And so I think, going back to what I said earlier, that blend of always on, really convenient digital servicing for most people most of the time, complemented by great people service when you need it, is a powerful and relevant proposition for the times that we're in.
Absolutely. We've talked quite a bit about what has gone on. If we can turn to the future, perhaps I'd be really interested in what your plans going forward. What do you have up your sleeve for savers in the future? Is it
my secret?
Sort of, yeah, absolutely. Whatever you can share, we'd be very interested.
Sure. Well, I'll share what I'm able to, James. I mean, I think the first thing I'd say is, I touched on it earlier. Actually, we do feel there's an opportunity to broaden our offer now across the Aldermore family, if you like. Savings has, within Aldermore, tended to be operating in relative isolation to the lending businesses, and I think we recognise that there's more we can do in terms of distributing savings across our mortgage business and our SME lending and corporate lending businesses. So I think that's one opportunity that I think we will definitely get behind. If I think about some of the interesting kind of product and market opportunities, I mean, since the demise of Help to Buy ISA last year, I still think there's an opportunity in the UK market for savings to sort of step up and support first-time buyers. They have kind of two real pain points, if you think about it. One is they need to build capital for a deposit, most obviously, but also they need to build a track record, if you like, for creditworthiness. And I think there's, particularly with the demise of Help to Buy ISA, we think there's an opportunity to build a proposition which is targeted at first-time buyers or potential first-time buyers, linking in with the so-called banker mum and dad, and really trying to tackle those kind of key pain points around getting on the housing ladder, as I say, building capital as well as building a credit profile as well. So that's kind of one area that I think is worth exploring. I think in terms of the more here and now, I mean, this has been an interesting year, hasn't it, to sort of say the least, which we could probably discuss at length. I think what it's done for us, James, is I think it's kind of led us to fill some gaps in our portfolio as we sort of tackle with the sort of fluctuations in demand. So I think one of the areas this is not new to the market, but would be new to Aldermore, would be to explore this sort of restricted access market, so-called. So those accounts that kind of sit between pure easy access and, say, fixed rates. And I think that's an interesting market space. And again, I think it's right for the times. The idea that you offer people a higher rate than they might get otherwise from easy access, but also with some accessibility that you wouldn't get with a fixed rate. So I think that's quite an interesting space as well. So there's kind of two areas that we're sort of particularly looking at. I think if I think about the servicing proposition, I talked about this combination of digital and human. I think you can always invest in your digital processes. I mean, the website is our only shop. We don't have a branch network. We don't distribute through brokers. So our website is our shop, and the online journey is our only journey. So by definition, we have to continuously invest in that customer experience, whether it's account opening or account servicing. So, we obsess about, for example, customers who drop out of the journey. in my mind, it's a crime that somebody has taken the trouble to find you, start an application, and then for some reason not get to the end. And we really need to make sure we get better at improving those digital conversion rates and not having to replace those lost customers by trying to find them elsewhere through marketing or pricing. So that kind of continuous investment in the journey. I talked about some of the offline processes and some of those more complex ones where I just think we need to take a fresh look at those processes. That they can often go wrong. They're often a source of complaints. And I think those more complex, emotionally intense processes, you just got to get them right and really think about how to do that using a combination of digital, but also people service as well. So I think, back to your question, I think it's a combination of market opportunity, product development, and kind of customer experience will probably be the sort of three main headings.
The restricted access piece is a really interesting one. It started to gain a little bit of momentum recently. I think there's increasingly a recognition that a lot of people want to retain some form of access, but that doesn't necessarily mean that they want to be in and out of that savings account all the time. It's that kind of security, I think, isn't it, of almost knowing that you can get at it if you need to, but it's that doesn't necessarily mean as a saver you actually want to do that.
Correct. I mean, I think it's one of those kind of best of both worlds.
Yeah,
I think it really does feel like it's right for the times. I mean, I know there's products out there already, so it's not innovative in that sense. But we feel it's a gap in our range at least, and I think it's it's one of those products that I think appeals to people because you don't know when you want the money, but knowing that you can get access to it, I think is important in a way that with a fixed rate, by definition, it's locked away.
Yeah. We've seen a huge amount of new entrants come into the savings market in the past decade. You've set the ball rolling, and there's been around 50 now, a mixture of new licenses and existing providers who weren't in the market have come in. There's more new banks on the way. I think we may see some this month. What sort of challenge does that pose for Aldermore?
I think first of all, you have to accept that more competition is ultimately a good thing, particularly for consumers, of course, because they tend to come in with good rates and more choice. But also, I think as an existing provider, it keeps you on your toes, and it, as I said earlier, it kind of ensures that you are continuously innovating across the piece, really. So I do think it's ultimately a good thing. I think what's interesting about the UK market is, despite that growth in rivalry, as you say, James, there's still a huge gap between the challenger community and the large established banks. Whether you look at that through the lens of rate or service or experience, there's clear blue water between the challengers and the incumbents. So I think, despite the rising competition, there's still plenty of market to go for. I mean, the market remains very concentrated even now. I mean, probably something like 3/4 of the market is probably still accounted for by the top 4 or 5 banking brands in the UK, even higher in business savings, actually. So There's plenty of market space despite the growth in rivalry. And I think it just, as I say, basically drives innovation and is ultimately, good for savers.
I think it's going to be particularly interesting, potentially next year. I think there's been a number that have seen their applications sort of take a little bit longer to get through this year than would be expected because of the climate. We could see a late run this year and a strong start to 2021, and potentially some big names in there with JP Morgan Chase brand and John Lewis looking.
I think what's interesting about the nature of the new entrants, I mean, they really do span the spectrum, don't they? So as you say, at one end, you've got the merchant banks looking to build a retail franchise. I mean, obviously, most notably Marcus, but then as you alluded to, people like JP Morgan, I think, are rumoured to be entering. And at the other end of the spectrum, you've got these very small, almost fintech providers. And so it's quite interesting that you've got this real diversity in the size and nature of the new entrants. I mean, certainly the merchant bank model is a very disruptive one, and they've got deep pockets. They can use penetration pricing very effectively. Obviously, that's what Marcus have done in recent years. So they probably represent a bigger threat. It's fair to say, certainly to the likes of Aldermore. But the market, as I said earlier, the market is still so concentrated that there's plenty of space to go around. There's plenty of headroom, I think, for all these new brands and the existing challenger banks to still grow. I mean, we certainly don't feel in Aldermore in any way market constrained, despite the rise in rivalry. There's still plenty to go at. And I think as long as you keep innovating and ensuring that there's this gap between yourselves and where most of the money still is, which is in the big established banks, then the opportunity remains.
I agree. I think it's a huge market, isn't it? It's approaching sort of 1.7 trillion in size, so there's plenty to go around still. It's been a hugely changing market in the past decade or so. What do you think we're going to see in the next few years?
Well, I guess most obviously and significantly, the interest rate environment obviously remains very low, ultra low by historic standards. By definition, that's not great for savers. It's obviously good news for borrowers, of course, but it's not good for savers. And that outlook is expected to remain low for the foreseeable future. I think the point is, though, it's all about the relative position rather than the absolute, James. So, despite, rates that even start with a zero, the market is still such that you can get, 50, 80, 100 times more interest with a challenger than you can with an established bank. In fact, paradoxically, savers are probably more rate sensitive given the low rate environment because they're trying to find that elusive yield and they're trying to find a real rate of return. So I think that's perhaps the most obvious kind of economic backdrop. I mean, you've got the prospect of negative rates that's being talked about quite a lot at the moment. I mean, personally, I think that's probably a distant prospect. I understand the rationale behind it, to sort of stimulate the economy. I think as far as savings is concerned, it would represent a kind of existential threat if that was to happen. I mean, the very notion that you have to pay to have your savings with a bank is kind of a whole new paradigm, and in fact actually could lead to all sorts of unintended consequences. Whether that's things like hoarding of cash or shifting to riskier equity based products. So I think it'll be interesting to watch, but my fear is that the cure of negative interest rates might be worse than the disease, if you like. I think another trend I'd pick out, and it's particularly true this year, is I think the COVID crisis has probably exposed just how precarious many people's kind of household finances are. We've surveyed several groups this year, and it's surprising what percentages of people have decided to prioritise their savings, particularly among younger people. And of course, one of the paradoxes of the crisis, if you're in work and being paid, then the chances are your expenditure's gone down, and that came through, as I'm sure you know, earlier in the year. The savings market grew very strongly in the sort of first half of this year. Really strong growth as people spent less and consequently saved more. I mean, the market softened a bit in recent months, but I do think the crisis has been a bit of a wake-up call for many people to sort of increase their level of rainy day savings and build that financial resilience. We talked about new entrants. I think they will definitely keep coming, and that's ultimately, say, good for consumers and keeps the incumbents on their toes. I think there's innovation in products still to come. I mean, it's interesting in a low yield, low rate environment, you're sort of seeing the emergence of these kind of different ways of paying interest. So these sort of prize draw based accounts, for example. I also think we might see the return of structured products back into the market. These products offer a combination of capital protection and the potential for higher returns linked to external indices. Now, I'm the first to accept these products have had a checkered reputation. But I think the current kind of conduct regime is now such that you would have to demonstrate very rigorous product design and very rigorous distribution. And I think if you pass those tests, there's no reason why these products couldn't be a legitimate choice for some customers. I think mobile apps will develop in the customer journey. I mean, they're relatively unusual as standalone features in the UK market. They tend to be linked to current accounts, but I think it's inevitable that mobile apps will only become increasingly part of the kind of core service for savers as well. So I think when I look across the future, I think whether it's in terms of rates, competition, product development, market development, I think there's still lots of interesting things to work on. And ultimately, these are good things for consumers. The crisis, nobody wanted the crisis, let's be honest, but if it does lead to an increase in the savings ratio and an improvement in people's financial resilience, then that must be a good thing.
Yeah, I agree. You mentioned there the rate cuts. Obviously, hard to have any conversation about savings at the moment without mentioning the National Savings and Investments.
Yes.
Significant cuts recently. What sort of impact do you still see that having on both yourselves and the wider market?
A huge impact, James. I mean, there's no doubt that NS&I have had a profound impact on the retail savings market, and in many ways, distorted the market. I mean, they had best buy pricing for a lot of this year. They've certainly absorbed a lot of the market inflows, and then of course they recently announced some dramatic rate cuts, which take effect at the end of November. So, we're seeing a real sort of seesaw strategy there. And there's no doubt that they've had a major impact on the market and the players within that market, particularly the smaller players and accountants in that, because we tend to appeal to the more rate-sensitive customer. Then I think we've tended to lose out, as it were, as NS&I priced aggressively earlier in the year. But conversely, we're probably now gaining as people leave them. So I think it has had a big impact. It'll be really interesting to see how NS&I plays out, actually, because they have a net financing target to hit by the government. And so it's quite possible, in my mind, if they see sustained and material outflows over the next few weeks and months, then it seems reasonable to me that they might actually re-enter the market potentially in 2021 in order to hit that net financing target. So an interesting one. I mean, currently, as I say, they're about to go right down the rate tables. So I think in the short term, it's really going to be how the market deals with that likely increase in outflows coming out of NS&I and where that money ends up, whether it ends up in people's current accounts or more likely, as people seek yield, enters the challenger banks.
I think it's been really interesting to see how it goes. I agree with you on the net financing target. I think the cuts are so severe that unless there's a change in that financing target, I think they will be forced to come back on some of the pricing in the new year to make sure that they hit that target for the end of March and the end of their financial year. I hate to use a COVID analogy, but I think we've had the first wave of impact of the announcement with people who kind of took the money straight away. But I think we're in a calm before the second wave, which will come later this month, with people who are sitting there saying, "Well, there's no point in moving at the moment. I can't get anything like what I'm getting, so I'll milk it to the final moment and then shift." So I think we're in for another period of volatility later this month when that money starts to shift, and all the indications anecdotally are that there's still a significant amount of activity. It's still difficult to get on the NS&I website and log on, which suggests that they're still seeing fairly high volumes, which I think will only increase nearer to that deadline for the changes.
I think December is traditionally quite a quiet month for savings, certainly for driving inflows. Tends to be a month of outflows, of course. But I suspect this year rather, I suspect it might be quite different. I think December could be an interesting month, as you say, as that money flows out and people actually, once they get through the wait times or the website times, that they will actually look for a fresh home for that money. So yeah, I think it's going to be interesting. And unlike you, I do think they may well return to the market at some point next year.
I think the current environment with people in lockdown means people are going to be around to be able to make those those calls and log on and actually have the patience to sit there and wait if things are taking a bit longer. Whereas maybe in other times people have gone, I can't be bothered, or it's not worth the hassle. But I think at the moment people have got the time and are able to do that. So I think it'd be really interesting to follow. Talking. We're kind of slightly veering towards politics, and Rishi's been busy today announcing extensions to the furlough scheme. If you were Chancellor for the day, what's the one? I appreciate he's had other things on his mind than savings, but if he were able to focus on it and you were in his shoes, what would you be looking at? What would be the change you'd make?
What a privilege to have this point. Am I allowed to, James? Can I have two? Of
course you can.
Yeah, okay. So I would definitely bring in the proposals around SEER, so single easy access rate. So this is the consultation that the FCA are doing, which in effect is about obliging providers to publish and set a single easy access rate for their personal savings and also their easy access cash ISAs. We think that's a great idea. It's basically very customer centric. It's transparent by definition. It promotes competition and switching, and it's good for the consumer. I think the FCA have estimated that there's about 260 million of potentially higher interest payments that could be generated. I mean, at Aldermore, we've already got a SEER. We've only ever had one go-to rate on our easy access account. We've never used introductory rates. So, in effect, we're already kind of SEER ready, if you like. But I think in the market context, I think it's an important development. I think it's a way of nudging people to consider, whether they can get a better rate. As I said earlier, a lot of the money in savings is still concentrated in the big established banks, paying next to nothing. And so I think that initiative is a welcome one for consumers and competition generally. So that'd be my first one. And my second one, if I may, is around the tax environment for savings, which I think probably could do with some simplification. If you take the ISA regime, it is quite complex, and of course you've now got the personal savings allowances as well. So it seems to me that the government could potentially create, a single tax wrapper in some way, combining the existing regimes, and really then use that to actively promote people to save more. And I think in doing that, James, I'd also find a way to consciously bias that tax favourability towards maybe the lower income or younger age groups who, let's face it, need to save more, whether it's first time buyers or just rainy day. I think the COVID crisis has really exposed some people's kind of precarious financial position. So, whether it's SEER or whether it's the tax treatment, I do think the government can and probably should take action to ultimately drive, a higher savings ratio in this country.
I think that's a couple of really, really good ones. I'm not so sure myself on how effective a SEER will be, but what I do think is actually there will never be a better time than this to actually get it through. I think you've got more chance than ever of getting people within the industry to sign up to it. And I guess I'm in the camp of I certainly would welcome from a savings perspective anything that would help, and anyone that's listened to me or read anything I've written over the years will know I'm a big fan of simplifying the current tax savings regime. It was beautifully simple when it was brought in, and it's become anything but in recent years. And I agree with you on the assisting people to get get started and get saving. I think the help to save that Cameron and Osborne brought in was a really good idea, but wrongly executed. But I think a revamp of something like that would be really.
I think
really
so.
good.
And keeping it simple, and to be able to pass the acid test of being able to ask somebody in the street, could you almost spontaneously be able to, describe the tax treatment? I mean, that sounds a bit daft when you say it like that, but the ability for people to get it quickly and easily, I think it has grown arms and legs over the years. Well-intended arms and legs, but I think
Yes.
I think there is an opportunity to simplify and rationalise, and as we both probably agreeing actually, to just to find a way to, in some way, bias it to those people that need to be saving, rather than, as it were, rewarding people who have already saved. I think that's where I think the government can and should probably intervene.
Yeah, I think unfortunately we may have to wait a little while for that, but I do hope it's. I think it possibly was on the agenda, but it's been pushed down. But I do hope it comes.
Yes,
comes back.
yeah, we do too.
Ewan, it's been an absolute pleasure to talk to you. It's been a really diverse and interesting show to record today. So I want to say thank you very much for coming on and giving us your time. It's been really interesting, and I hope it's a good listen.
Thank you, James. I really enjoyed it too.
Thanks very much, Ewan. Take care.
James, thank you.